Hi, morning everyone, and pleasure to be here with a thin but interested audience. And we've got a fantastic panel here. We've got Eva. Eva is the Chief Commercial Officer for Maersk, yeah, and she's braved the rain and braved the traffic to beat the clock by a minute. Well done, Eva. She's been with Maersk since 2020. And she's responsible for sales and service to ship owners and engagement with partners. And she's involved with both the Ds of shipping, decarb and digitalization. So she leads that effort for Maersk. Yeah? She has a background in telecom, very interesting, and she has a master's in business from Aarhus in Denmark. Welcome, Eva. We've got Rohit sitting to the left of Eva. He's General Manager for Tankers and Gas for Pacific Carriers Limited, and he manages the commercial business and operations. Been with them since 21. Yeah. But before that, for 13 years, he was with the BW Group, where his last role was Senior Manager Commercial for BW LPG. And he has an MBA from Chicago Business School, Booth. And to the far left, we have Matthew Blake. Matthew is Teekay's Head of Business Development. He is an eternal optimist, which is a great position to be in where the markets are today. Yeah, 20 plus years with Teekay, has done spot, time charter, everything under the sun, and very recently back from a lovely holiday in Fiji. Welcome back. So we've got half an hour to talk through a few things. And we're going to sort of go through it in broad themes. Yeah, the first themes are on the tanker markets. There's a lot of optimism. Yeah? And so, what are the fundamentals and where are the risks? So, can I start with posing the question first? Yeah, and then I'll ask different panelists to comment on them. So, the question is: for now, it seems like the tanker markets are reaping the dividend of a war. Yeah. If the war were to end tomorrow, yeah, what fundamentals backstop the market? So if I can ask Eva from a product tanker standpoint, could you please comment on that?
Super, and I'd love to, Anoop. So actually, before we went into the 24th of February, we were definitely doing our analysis internally as well. And what we actually had of different scenario plays was all about what would actually happen if they went into a full-out war and all of the oil was sanctioned right away. And definitely also there, we could also see that we were expecting rates to actually rise. We were also expecting that we would have extra ton miles going into different scenarios as a basis. But at the same time, we were also looking at already back then some base fundamentals and supply and demand within the tanker space that looked really promising. Because basically, we're still seeing around a 1% growth in demand, and the way that the actual supply of tanker ships look at the moment, we could definitely see that the whole market from a fundamental basis was actually going to become rather tight. So what I'd like to say to the roaring, and whether it stops tomorrow or not, the war, I would say that the base fundamentals in the market are there for it to still tighten, because, I mean, basically if you go out and order a ship today, it won't be delivered until 2025. So it means that we really have a supply of tonnage that is going to be strained for the coming years. And then at the same time, we will also not see an oil maximum yet. We will still see a little bit of an increase in demand ongoing. So I think we have a strong fundamental market, and if the war continues, I think we will also have some volatility that is going to go into the prices, also with the energy crisis, and potentially we will, at least when we actually see the full sanction regime, have the extra ton miles. So it means that we probably have an extra jump in it for us for the freights.
That's the upside if ton miles do stretch and the sort of war carries on. Matthew, Teekay has a large position on dirty tankers, crude tankers. So what are your thoughts if the end of an aggression very soon? How do you see that play out?
It's an interesting question, because I think if the aggression does finish, we just don't see the end of the inefficiencies along with that. I think from a crude perspective, we obviously see sort of Europe sort of falling back to Russian crude, but we also, I think, are going to see a lot of questions about energy security and diversity. That, we've realized that Europe can't depend on the gas supply from Russia. So positive for oil. If the war was to end tomorrow and things return to normal, the stick of dynamite that's been placed under the tanker market is removed. But we always thought 2022 was a year of two halves, with a softer market in the first 6 months and gradually tightening in the second 6 months to a sort of a longer upcycle based on supply of ships. So if we do remove that stick of dynamite, I do think that we'll see an uptick in scrapping. And if we see that, then the tanker market, the crude market stays very tight indeed, based on supply-side economics. It would be a positive for the war to end, but it's not going to change the tanker market in leaps and bounds.
That's interesting. So both Eva and Matthew are of the opinion that there are sort of fundamental supply-demand legs for the market. The froth, as you see, the dynamite below the markets would go off. Rohit, not to say that you're the pessimist in the gang, right? But if I were to ask you to sort of poke a few holes in the theories, where do you see the top 2 or 3 risks for the tanker markets, maybe over the next 12, 18 months, 2 years?
I think the way the market is at the moment, it's very finely poised, and there is significant upside potential. That's what we believe in. And I think it's been catalyzed by this war. I think return to life as normal as we had known pre-COVID, and the return of demand, I think that is one of the major drivers as well, in addition to the points that were raised by the other speakers. But that's also a double-edged sword. If we continue on with this zero COVID policy in China and how that's going to impact, that's potentially something that can throw a dent in this market. And in addition to that, I think there's also fear of inflation and whether that's going to actually dampen demand. So we're watching these areas very closely. Inflation is a real thing. Costs are going up. Costs of operating are going up. We've been through a couple of years of very high costs due to COVID. We are now in a position where we want to try and rein in some of those costs. But I think
operating costs.
Operating costs, yeah. To try and rein in some of those operating costs. But if we get into this inflationary period that we're looking at, then that puts a significant dent in that area as well. So these are some of the factors, but of course it doesn't matter if you're making about $50,000, $60,000 a day. A small increase in OPEX is largely ignored. So
it's hard to get a negative or pessimistic word from a ship owner. But you did mention China, right? And that's something that we could cover as well. The country's had a lot of economic headwinds, right? And although the VL market is up to $100,000 a day, but really on a fundamental basis we're missing Chinese demand, right? And that cuts across both clean markets and dirty markets both, right? So the question is that, and it's a tough one to call because China is a bit of a black box when it comes to data and information. But when and if it comes back, what are the views of the panelists on, does it come back like a fire-breathing dragon, or is the trajectory reset for lower? Yeah. So if I can start with you, Eva, on that.
Yeah, so I think our fundamental belief is definitely that China will come back. Whether it starts out as a dragon, as you call it yourself, I don't know, but I think it will definitely rise to the same strength. Actually, one of the situations that we are monitoring very, very closely, because we think it's going to have an impact also to some of the scenarios that you were mentioning, Rohit, on inflation and also on a potential recession, is actually the situation with Taiwan. Now, if this goes in and tightens immensely, there is a risk that we will actually see a further drop in basically some of the production products that are actually coming out of Taiwan, so the different chips that are used in a broad range of products today in Western markets. And when you have a country like Taiwan that produces almost close to some 50 to 60% of the world's need of chips, we actually have an issue. I mean, they go into everything. They go into windows, they go into steering elements, and a lot of the intelligence / digitalization of different products. So I think it might hamper production in the rest of the world, which again then will actually sort of spin in and kick even further into lack of production and recession. So again, that could be an element that could be negative because it just sets down the productivity and the product of the world.
Chips to ships, interesting. Matthew, what are your thoughts on China? Because dirty market obviously is a lot more geared towards that market.
Yeah, absolutely. Yeah, I don't see China roaring back with a zero COVID policy, but I do see China, gathering momentum and being remaining a force in the market. Also, quite interestingly, I think on the product export side, China's got a huge role to play with the refining capacity and the availability that they could put into that market. So, we're not just crude tankers at Teekay. We do have LR2s, and we're very excited about what can happen in China over the coming 2 or 3 years.
Slightly prompter, because China is probably on the verge of announcing a big slug of product exports. Rohit, are you seeing anything on the product tanker sector in terms of an imminent increase in exports out of China? And if I can extend that, do you think the policy that China has been embarked since last year of not exporting too much product, do you think it's here to stay, or do you think it's just sort of managing a transition, and with everything else, they might go back to a default mode of operation at some point in time?
Well, I think we certainly hope that it'll go back to a default mode. In terms of the 4 tranches that the Chinese exports have been allowed for this year, as has been in the last 4 years, is significantly lower than the previous years. So that has had an impact on the market coming into this year, but the rates have been supported even without those volumes. So if anything, additional volumes are only going to support this market further, which is why we feel that going into this winter, we should have a strong market especially on the products, especially in the east, and the rates are being supported at the levels that we are seeing right now for the last about a month or so, and the rates have been supported at very, very healthy levels.
Although if the product export quotas do come out, then it'll be a bit of a dynamite, as Matthew says, under the tanker markets, right? The other theme that I'd like to touch upon a little bit is the threat from the emergence of a shadow fleet to carry the Russian crude, Russian flows, right? If we were to paint a scenario, and unfortunately that's what we kind of are ending up doing now. Everything is about scenarios other than certainties. The market, the environment is so geopolitically challenged to forecast. So in a scenario that price caps fail, which means that more and more Russian crude exports and product exports need to go on a shadow fleet. What's the scale of that risk for tanker demand for the mainstream vessels which your respective companies operate? So we can start with Matthew yourself on that.
It's going to be interesting. So there's probably 100 Aframaxes in the shadow fleet, maybe ADVs and some Suezmaxes and LR2s. If we see Russian crude primarily going on the shadow fleet, that fleet has to increase. And we've seen tremendous second-hand buying of 15-year-old tankers, so I think we all have a good idea of where some of these ships are going to end up. But having said that, shadow fleets trade very inefficiently, and no doubt they're going to earn a lot of money transporting Russian crude. But to transport that volume of Russian crude, you're going to need a lot more ships to join that fleet. So that in turn will take ships out of Cross-Med, out of Southeast Asia, out of Indo-Japan. And it's going to be a rising tide for the non-shadow fleet. The fact that, yes, we're losing access to a lot of Russian oil, but we're also sort of seeing the supply of ships tighten a little bit further again. So yeah, it's by no means certain that it's a positive, but it's going to take a supply of ships away from the international market.
So what does it do to the dynamite? Does it still remain, or do you think that gets doused a bit?
What do I think the market will be for the non-shadow fleet?
Yeah.
Ton-mile driven demand is going to keep it firm. Until, going back to the first question, until the war finishes and we return to a more normal world, we're going to see a big increase in ton miles. And until that equalizes out, I don't see sort of TCEs dropping. Stabilizing but not dropping.
Still healthy investment grade returns is what I hear from you.
Absolutely.
Okay. Investors in the room, please take note. Eva, any thoughts on that at all?
No, I think maybe just to add a little, because I do agree on that the actual supply is probably going to fall within sort of the white fleet that is left. And I actually also think that even though the war should stop, I still think what we will see from the European countries is actually the extra ton miles keeping on going. Because I don't think that the Europeans will ever, from a political point of view, allow for that necessity to get Russian oil in as part of our energy mix. I don't see that happening. I see increased collaboration between allies, which means that probably we will still continue to get our energy sources from elsewhere.
So you're looking at it as a long-term rift between Europe and Russia?
Yes, I am.
Rohit, any thoughts on that?
Yeah, I think sanctions is a very complex area. So as a ship owner, it's very, very difficult to say, are we on the right or wrong straight away, because there are exemptions given for certain cargoes to move, etc. There are definitive timelines for that given at this point in time, 5th of December and 5th of February. So we're watching those dates very closely. But I think the expectation is if the rhetoric continues, and if there's what we see in Europe, if that continues at this point in time, I think that the sanctions are likely to be extended further. So it makes it difficult for owners like us, for example, who are not keen on breaching sanctions, etc., or being on the gray line. It becomes very difficult for us to call those ports, and so we have largely tried to stay away from that business through this year, and I think in the near term, I think that's how it will continue to be for us. So I'm sure there are a lot of owners in the same mindset as us.
Thanks for that. Shifting gears a little bit, on the supply side, a lot of the optimism has been driven by the fact that there's not too much supply coming through. It's 24, 25. But the fact also is that you need new vessels in the fleet to position yourself for CII compliance, as we go into the second half of this decade. And I think all of you are sort of representative of ship owners in some way, shape, or form, right? So if I were to ask you a question around what is the primary sort of dissuading factor for placing a new build order today? We can make it a multiple choice question, Is it new building prices, which are very high? Is it the fact that you don't have sort of use-ready technology for 25, 26, and 2030? Is it because slots are too far forward, or do you think there's a real risk that tankers could become a stranded asset before the end of life of a 20-year-old vessel delivering in 25? Or all of the above, or something else? Why don't you have a go, Rohit?
It's probably close to all of the above, maybe not the last one. I think the energy demand that the world has today, and I think one of the speakers spoke about it yesterday as well, oil and gas has to play a large part in that for several years to come before we can offset it with other sources of energy. So in that sense, I don't think tankers necessarily will become stranded assets. But of course, as responsible ship owners, we all have a role to play towards decarbonization, etc. We are looking at various projects ourselves, and to find the right solution. The way we have gone about this ourselves is to work with modern ships, which are eco, tier 3 compliant, etc., and focus on the incremental changes that we can make going up to 2030. So I think those are some of the things that we've been looking at ourselves.
So would you enter the market today for a new building? And if yes, great, but if not, then why not?
I think we are one of the few owners who have actually placed new building orders for 23 and 24. 23 were resales, and 24 we placed the orders. We took some options because we found them to be fairly attractive commercially, and also in our bid to increase the scale of our fleet, but also to add it with modern tonnage. That was the driving force. But you're right. I mean, in terms of getting new building slots today, I think the earliest slots we can look at is 25. At least the leading yards which build MR tankers, which is the segment we are in, have given us dates of earliest dates being 25. And yeah, there is a lot of uncertainty out there. I think we need some clarity before we can venture.
So long dated slots and uncertainty. That's where you are. What about yourself?
So I think right now the issue is probably that when you're looking at a shipyard, you won't have a vessel until 2025. It becomes very difficult to combine that with knowing that probably there's going to be a lot happening, both on the infrastructure and the actual new fuels. So it becomes very difficult to know what exactly you should order at the moment, because that will sort of depend on what of the fuels are we actually expecting to see, what are the routes that you're expecting to take. So I think the price levels and basically the waiting time, and then sort of spun in with what is the right technology actually going to be, because there's so much development right now in the new fuels and it's going really fast. So I think I would be wary as to what is the dual fuel that I'll actually choose.
Right. So emission-ready technology, it's interesting, nobody's talking about new building prices. So the markets are great. Matthew?
I think it's a similar response. It's a very expensive asset to buy now and deliver in 25 or 26. And hand on heart, I think it will be a good market, but I wouldn't have a clue what the TCE is going to be in 25 or 26. Technology is a huge constraint. We just don't know what to buy at the moment. But having said that, I also think we've seen a lot of sort of talk about that oil is going to diminish maybe as a transported product. But we're also sort of looking to the oil industry to start making that investment. So that probably isn't the case. We're confident through 2040 that the demand for our ships will still be there.
2040.
We just need to figure out what ships they're going to be.
Fantastic. So we've got a couple of minutes left, and I think one key theme is decarbonization, EXI, CII, and so those are short-term measure, but broadly speaking, even longer-term measure, right? So my sort of pet theory is that you need scale at an ownership level to decarbonize, because you need to have the money to invest in these products. But Maersk brings lots of commercial scale, yeah, in the business through the pools, right? What are the opportunities that you think pools provide for ship owners if they want to comply better with CII regulations or EEXI regulations?
Yes, I think first of all, the scale actually enables us to invest. So the actual optimization that we can do on each and every voyage and basically operate them more efficiently with the software that we use in our operational setup, I think is key. And we also have an opportunity to go in and optimize on the bunkering and each steering of the vessels. So I think there you have suddenly the voyages, you have the vessels, which we do via a bunker team. But I think what is really unique when you actually get scale is that you can go in and you can optimize at a fleet level. So by actually having access to more vessels, you can choose the right vessels for the right trade and actually secure that the vessels are driven most optimally in order to secure the CII rating. So I think that's key.
I think that is key, because CII will be impacted how the vessel is traded, not just how it is built. Rohit, you've got some interesting young tonnage, right? And in our private discussions, you were saying some of your vessels will remain an A-rated vessel for the next 10 years if well operated. So for an owner of these fantastic vessels, strategically, what are your thoughts? Where are you leaning, and how can you best gain value for these young modern assets?
I think, we had to go back a little bit. It's our second foray into tankers for PCL, and it's only been 5 years in this stint. And we focused on trying to get the right asset mix for our fleet, and we've gone the new building route through the 5 ships in 2020 and the 4 that are coming. They're good assets. They trade very well. We're seeing them being utilized on long-haul trades these last couple of years, the ships that we've had. We think that they will be the workhorses for the similar type ships will be workhorses for the market. So it does give us some advantage in our discussions with the players that we are keen to work with. We started out organically, so we started out as a traditional tonnage provider sort of model, focusing on trying to get our operations and technical management up to speed and up to the standards that we want to operate at, continuously trying to improve ourselves there as well. But now we are in a position, and with the market like it is, to hopefully take some advantage of that, of having these good assets as well. So I think we will slowly shift a little bit more towards perhaps being a bit more on shorter time charters or spot or even pooling, if that makes sense for us, and continuously try to optimize our asset whilst we're operating them.
Right. So not looking to let the charter take the most advantage of the vessel, kind of operate them in short-term TCs and the spot market. Interesting. So Matthew, if I can bring you in on this, your fleet is a little bit more compromised, slightly older tonnage. But do you think CII, EEXI can be managed over the next few years, and what are the kind of things that an operator could do to make sure that the useful life of an asset is maintained and it remains a productive asset?
Yeah, it is a challenge going forward, CII. I think it's also a big opportunity for us that come 2030, a lot of our existing fleet will probably no longer be with us, so we have a blank sheet of paper to make a big investment at some point. But going back to CII, we've done a lot of work over the last 5 years or longer, putting newest ducts on, getting the right silicone paints on the hulls, PBCFs, all of the efficiency measures we can. So when we look at our fleet, we think it stacks up very well against ships of a similar age, and even some younger ships. CII for us is going to mean that we need commercially to pick the right voyages. I mean, like, for example, an Aframax will have to have 48,000 laden miles per year in 2024. and I think that will increase per year after that. So that's about 160, 170 laden days. But we need to do it with a clean hull as well. We can't do it with a dirty hull, because otherwise we're just shooting ourselves in the foot. So it's going to be a very big challenge to make sure the ships are clean, pick the right voyages at the right time. As Eva said, pick the right ship for the right voyage. And we've got the scale to do that. But I also think with the sort of supply-side economics that CII is, it's a challenge, but we're going to see that oil companies or users of tankers are not going to shy away from ships rated D or E. You know, I think those ships are here to stay for a few years.
Thank you. Very forthright, Matthew. Thank you very much. So that brings us to the end of our 30 minutes discussion. We could have had 40, 45 an hour. Please join me in thanking the panel. Well done all. Thank you very much.